Now I'm going to turn my video off for the presentation to avoid distractions and the like, but I'm going to pop back up again at the end when we look at the Q&A. So the objectives of the session today, pretty much as the title suggests, is that we're looking to introduce people to the basic international tax structuring concepts. What is it that drives what we do? What is it that we need to look at when we're putting cross-border investments together? And we'll also be trying to provide a basic understanding of not only the drivers of that, but also the tensions that are created by various aspects and the reliefs that may be available to us in doing so. What we will see, though, is that the world is changing and that some of the reliefs that might otherwise have been available to us in the past are not materializing, and on the other hand, the tensions are getting greater. Also, this session is to provide a framework for future GT seminars in which we'll be doing a deeper dive on some of the aspects. So, for example, we won't be looking at things like transfer pricing in depth because we'll have separate sessions to deal with that going forward. So the session contents, first of all, we'll be looking at the various, when I say various, the two international bases of taxation and what that means, what tensions are created as a result of that. We'll be looking at what I call the critical role of the fuzzy concept of residence, because it is such an important feature of international tax planning, but arguably it's so fuzzily defined that certain difficulties are created around that. Talking about things like the reliefs, usefulness of tax treaties. Tax treaties are there to provide relief from these conflict situations, and we'll be taking a bit of a stroll through those. And then the final two pieces, the building blocks of structuring. What when you're putting together an investment, a cross-border transaction, are the real things you need to get your mind around and get correct and get in place to the extent that you can. And then finally, as I mentioned, the trends in international tax planning. The world has changed. The reliefs that might have otherwise been available seem to be dissipating in the wind, and the complexity and confusion, on the other hand, is increasing, and we'll see some of those trends at the end. So, sorry, international bases of taxation. So this is the real starting point, and that is to get your mind around that there are only two types of income. That is locally sourced income and foreign sourced income. In due course, there may be income from other planets and the like, but on planet Earth, for the time being, you need to determine, in terms of your income streams, where they are sourced, because that is going to determine where they may be taxed. And almost all countries in the world will tax income that is sourced in their country, unless they have some specific incentives or tax exemptions that allow you to get out of it, or unless, as we'll see later, treaties can come in and provide relief. And foreign sourced income is income from outside your jurisdiction, which may or may not be taxable depending on the basis of taxation that applies to you. And there's only two bases of taxation. One is a worldwide basis of taxation, and that is where people and companies that are tax resident in a particular jurisdiction are taxed on their worldwide income. In that situation, source can still be relevant because you can be taxed in another jurisdiction, but it is less relevant immediately for you because you need to tax the people that are resident in your jurisdiction. So as a result of that, knowing whether you're resident in a territory is critical. The other type of, or the other basis of taxation is a territorial basis, and we see countries like Hong Kong and Malaysia who tax only income that has its source in those territories. Up until Hong Kong decided that it needed tax treaties, it didn't actually have a concept of residence. All it was concerned about was whether people, wherever they happened to be, were either doing business in Hong Kong or had created some sort of other source of income in Hong Kong. And then you have the semi-territorial bases like Singapore, which sort of muddies the waters somewhat, because Singapore doesn't tax income that is sourced outside of Singapore until it is brought into or remitted into Singapore. So that's a sort of halfway house, if you like. For these guys, as far as determination of taxation, principal taxation is concerned, residence is largely irrelevant. As I said, Hong Kong didn't need the concept until it started entering into double tax agreements, tax treaties. For these countries, the source is absolutely critical. So let's have a look at the concept of residence. As I mentioned before, it's critically important to know if you are resident in a country that has a worldwide basis of taxation, for the simple reason that you're going to get taxed. Whatever else you do and wherever else you do it, you're going to have a primary obligation to pay tax in that country. But does it matter if you are resident in Singapore, for example? Well, I think I partly mentioned that or answered that question in relation to Hong Kong. The answer is no. It doesn't matter in relation to whether you're taxable or not. All you're worried about is whether you have a source. But yes, residence does matter in the context of Singapore. If, for example, it is claiming benefits under Singapore's tax treaties, because as we'll see, that's one of the determinants of being able to use a tax treaty is residence. And if you're claiming things like exemption for foreign sourced income, which only applies if you happen to be resident in Singapore, and it doesn't apply to non-residents. Whoops, sorry. Let me go back. So what's the problem with residence? Well, the easy problem is that it creates double taxation, and double taxation arises when two or more countries impose tax on the same taxpayer in respect of the same income or capital. So there's two countries actually wanting a bite of the same cherry. This generally only arises as a result of residence-based tax systems, as I'll show in the next diagram. Singapore, unfortunately, somewhat messes the thing up with its ability to tax remitted foreign income. So whereas it primarily has a territorial basis of taxation where this shouldn't arise, it does rear its ugly head when you start talking about remitting foreign income into Singapore and taxing it accordingly. So here's a quick diagram of effectively double taxation and the difference between the two bases of taxation. So if we have a Singapore company that has borrowed from a UK company, it pays interest, it suffers a 5% withholding tax under the treaty, and the UK rate of tax, for the sake of simplicity, is, let's say, 20%. So what happens is that tax is raised on the interest in Singapore and tax is raised on the income in the UK, because the UK taxes on a worldwide basis, and it doesn't matter that the source of the income, the interest income, may be Singapore. If, on the other hand, we're paying interest to Hong Kong, well, you'll notice there the withholding tax is slightly higher because we don't have a tax treaty with Hong Kong. But on the other hand, because Hong Kong's got a territorial basis of taxation, it doesn't tax that income. Therefore, double taxation does not arise. And you could raise the question as to why Singapore and Hong Kong would want tax treaties anyway, apart from a potential reduction in withholding taxes, which we'll come back to in a minute. So if residence is such a critical factor in everything, because it determines who and why you may be taxed, how is it defined? Well, as you'll see from here, if you're looking at Singapore and you're looking at a company, the company is resident in Singapore if the control and management of its business is in Singapore, and that's as defined. A company is resident in the UK, though, if it's managed and controlled in the UK. Now, there's a distinction here. There's no mention of its business, and the words are the other way around. However, we still rely, and some of you may have seen tax advice talking about the question of residence, and people still rely on UK case principles, even though, you know, this wording is different and the concept could be slightly different. But a company can be resident where it's incorporated. So the United States, for example, if you set up a company in the US, it is resident in the US. And the US, as we know, taxes on a worldwide basis. So that should be ringing alarm bells, apart from anything else. Under treaties, a company is resident in the contracting state in which its place of effective management is situated. What does that mean? And then finally, some places like Japan say it's where its official registered head office is, or I think even France do that. So you've got a whole hodgepodge of different definitions, nuances of what is meant by residence. And the unfortunate thing about that is that because it can be the most critical thing in determining where and whether you have a tax liability, you know, one could raise the question as to whether rather than running around with all the BEPS initiatives, base erosion and profit shifting initiatives, we shouldn't be focusing on some of the more fundamental issues like what on earth does this mean in particular situations. And I think part of that has been exacerbated in the COVID situation, where the music has stopped and people have been left frozen in particular jurisdictions. That is raising questions about tax residency, not only for businesses and companies, but also for individuals. So it seems a very fluid and flimsy way to go about determining how and where you should be taxed. But we are where we are. So the question is, what can we do about this double taxation that a worldwide basis of taxation based on residence actually creates? Well, we can get relief in various ways for double taxation. We can either get that through domestic law, where the local law says that certain things are exempt. So for example, in Singapore, we've got section 13.8, which says that if you've got foreign sourced income that has been taxed at acceptable levels overseas, then we will exempt it when it's brought into Singapore. And that's re-establishing, I suppose, Singapore's territorial basis of taxation, that it doesn't care. If it's overseas income, if it's foreign sourced income and it's being taxed appropriately, we're not going to tax it again. But it can also be dealt with through tax treaties. And we'll have a look in a minute at what tax treaties actually do for us. But the general concept is that they solve some of these double taxation issue problems, but they also at the same time reduce the incidence of tax in certain situations, just to make to make sure that everyone gets a fair slice of the pie or bite of the cherry, as the case may be. So let's have a look now at tax treaties. Two objectives, and this is from the OECD model commentary: for the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income and capital gains. So avoidance of double taxation. But the second element is the prevention of fiscal evasion. And what we'll probably see later on when we look at trends in tax planning is that the concern about the avoidance of double taxation tends to have taken a back seat in favor of measures for the prevention of fiscal evasion. Those of you who are familiar with what is going on in terms of exchange of information, etc., will see that treaties have been amended, expanded, and augmented around that particular concept. So what are the benefits of treaties? Encouraging cross-border commerce through reduced tax burdens. And that's an important feature of that is reducing withholding taxes in the source country. If you think about it, withholding taxes are based on the gross revenue, but income taxes are only imposed on your net revenue. So you can end up in a situation where your withholding taxes are so high that it actually makes it commercially unfeasible to do business with that particular country, because you end up simply making a commercial loss because of the incidence of those taxes. So what the treaties do is they try to reduce the levels of withholding taxes to make that easier to swallow. And then exemption or some form of credit relief in the recipient country. That's again aimed at reducing the incidence of double taxation and the overall burden of tax. The aim also is to clarify the taxing rights of each country. Can you have tax rights over this, or can I have taxing rights over that? Determining the method of relief, which we'll come to in a second. Providing certainty, although I've yet to find a treaty that provides total certainty on most things. To provide an avenue for dispute resolution, so where we have a transfer pricing dispute, and the two countries are saying this should be taxed here, and the other one's going, no, it should be taxed there. There are mechanisms through the treaties which allow for that dispute resolution. And as we'll see, and as just explained, to provide for exchange of information and therefore augment or reduce the ability of taxpayers to evade taxes or avoid taxes in an unacceptable manner. So, relief from tax treaty, from double taxation. There's one particular section or one particular article in treaties that deals with this, and there are a number of ways of getting it. In fact, not entirely true, because the very first one, no PE, no tax, comes under the principle that if you are a non-resident in a country, excuse me, but you are carrying on business for significant tracts of time in that country, you have created a source of income there. What the no PE, no article says is that if you haven't created a permanent base in the country, then we will accept that you haven't created a source of income in that country. But the other ones I mentioned: reduced withholding taxes on royalties, interest and dividends primarily, exemption in the recipient location for income, but again, as I mentioned, that only affects the worldwide basis of taxation candidates. Exemption with progression, which is where you get an exemption, but the income is taken into account in determining your tax payable on your other income. So for example, if you've got graduated rates of tax, the exempt income nevertheless pushes you up the rate bands. Foreign tax credit in the recipient location, where they say, okay, you're paying tax here in your country of residence, but we'll give you a credit for the tax you paid in the source location. And the final one is relief by deduction, which means you sort of get taxed again in the recipient location, but you only get taxed on the net amount of the income after any foreign taxes. Excuse me. So rather than giving a direct credit, you just get taxed on a lower amount without any further credit. Some principles of treaty interpretation, which people consistently still get wrong. Tax treaties override the domestic law. So if the treaty says this, then that's this. There should be no argument about it. Also, treaties can't impose a liability to tax. They can only give relief. So that means that if there's no domestic liability to tax, there is no liability. You don't even need to open your tax treaty. Other rules of interpretation: where a definition exists in the treaty, obviously use that one. Where it isn't defined and there's a domestic definition, then use that one. And where no definition exists in either, use your nodal or look it up in a dictionary and give it a natural meaning. Oops, have I jumped a couple of slides? Ooh. Sorry, my mouse is playing up. The other thing, interpret the spirit of the treaty. So think about why the treaty is there, not the precise wording, because these things were originally written in French and probably badly translated in many parts of the world. But it seems the Australians are sort of moving that concept outside what it originally was meant, and looking more closely at the actual words in the treaty. And the other thing you must always do in a treaty is read the whole damn thing, for a number of reasons. First of all, exclusions lurk. And I remember a very memorable occasion when a global head of tax from a rather large international music group came into our offices and announced that he was setting up Singapore as their copyright, royalty, intellectual, because under the Dutch treaty there was no withholding tax on royalties. I then took him further down the article, which seemed to give withholding tax exemptions, and said, unfortunately, the last paragraph seems to suggest that this article does not apply to copyrights of music, films, cinematic, etc., for broadcasting. Slight embarrassment, given that the structure had already been set up before they came and spoke to us. So always read the whole thing. And what's happening more often now is protocols are getting added to treaties. They are being augmented by new tweaks and changes. Here's a quick overview of a treaty and what they do. We're not going to stop and smell too many roses on the way, just pick up a couple of salient points. Obviously, persons covered, that tells you who's covered. The taxes, income and capital gains primarily, some general definitions to get you going. And then, of course, the definition of resident, which, as we know, is very, very important. But in this context, it's more important on determining who has first bite of the cherry, because it deals, this section effectively deals with conflicts when there might be a contention in one location or the other. permanent establishment, we've got a little slide on that, so we'll come back to that in a second. And then the rest of the treaty, a lot of which should be fairly self-explanatory from the titles. Obviously, the dividends, interest, and royalties are important because they, in many cases, give reduction holding taxes. Capital gains are important because some countries tax gains on the disposal of shares in their jurisdictions, and some treaties give relief for that tax. Income from employment, how do you get caught up in the local tax net, and how do you get relief from it, etc., etc. And down to the last one, which is other income, which is effectively dustbin, which deals with anything that isn't dealt with in any of the other articles. And it can either say one of two things. One, that domestic law prevails, and so nothing changes. Or two, that the recipient, only the recipient country has taxing rights. And then Articles 23 and 26 there are probably the two most important articles in the treaty in many ways, because they encapsulate what the treaties are about: elimination of double taxation and exchange of information, how tax authorities can pass tax information around about one another. So that's just a quick rundown of the of what typically you'll find in a treaty. It's based on the OECD model treaty, which most modern treaties tend to be based on anyway. Now here's a little for you. To whom do tax treaties apply? Well, contrary to what many people say, they apply to residents in the recipient country and the source country. You do not have to be resident in both countries for the treaty to apply. You need to look at the source of the income, and you need to look at the residence of the person who's receiving the income. They don't both be, and I'll show you why in a second. Singapore company paying interest to Dutch company. Which treaties do you use? Well, duh. You've only got a choice of one. So we'll move on to the next slide. In this situation, a UK branch of a Singapore resident company has borrowed from a Dutch company. It's paying interest to it. Which treaties or which treaty? Well, the answer is not the Singapore-Netherlands Treaty, but the UK-Netherlands Treaty, because the UK is the source of the interest, because the UK branch was the one that did the borrowing and used the money. So Singapore doesn't come in to this. In this situation, Singapore's borrowed from a UK branch of a Dutch resident company. Which treaty do you use? Well, the source of the income or the interest is Singapore. It's being paid out of Singapore. But the tax residence of the recipient is the Netherlands. And so you wouldn't use the UK treaty in that situation, you'd use the Dutch treaty. And then to complete the picture, probably got my branches mixed up here, but the treaty here, if the source of the interest is the UK, then you would use the UK treaty with the Netherlands. You wouldn't necessarily, in the absence of any local provisions, be protected from withholding tax or anything else because it was paid from a UK branch to a UK branch, you would need to look at what the Dutch treaty did for you, because that's taxes covered by treaties. We've already effectively dealt with that. So these things you will not find in there. You won't find inheritance tax and the like in there. But you can include municipal and local taxes sometimes, for example, in Swiss treaties. Permanent establishment is essentially how you get caught up in a particular country into its tax system because you are spending too much time there carrying on your. This usually requires a degree of presence, although as we'll see from some of the BEPS changes that may be coming down the tubes, this presence isn't always going to be a necessity. And usually in the treaties, but not always, and only in respect of certain types of establishments, there may be some minimum time requirements before you trip the PE and you have a tax liability in that country. The aim generally is to get the mechanics of local tax administration if your visit to a country is deemed to be only permanent and not, temporary and not present. The thing to note, though, is that not only does it apply in a situation where you might have employees spending time in a particular country, but a PE can be created by third parties who you hire, who have and habitually exercise, as they say, an authority to conclude contracts on the principal's behalf. And that's one that you have to be careful with because it's not always obvious that that is happening. However, there is a let out for that under the treaty, which is that if your agent happens to be of independent standing, i.e. he does this for a number of people for remuneration, then you can get out of the PE trap. Capital gains, as I mentioned, some countries tax shares in companies in their jurisdiction, but some treaties, not all treaties, actually let you off. But what we're finding now, certainly in Singapore's treaties, that it is very rare for that exemption to be given for land-rich companies, i.e. companies whose value is primarily made up of real estate situated in the other territory. And then double layers through this mechanism they call taxation of disposals are being attacked, and we'll just look at that in a few minutes. So there are obviously anti-avoidance provisions in treaties, and these have become exacerbated again on the back of the BEPS initiative. So this sort of stuff isn't going to go away. I'll come back to that in a minute. We won't go through any detail here for the moment. So the building blocks of structuring. What are you trying to do? Well, almost any cross-border transaction or planning, these are some of the things that we are looking at, with the primary objective, obviously, being to legitimately reduce the amount of tax you're paying, either in the source location or back at the ranch in the head office. Some of these strategies can include debt funding, getting tax deductible expenses down to the operating level. The use we mentioned to reduce withholding taxes, to make sure that we get foreign tax credits, etc., and avoid double taxation. Transfer pricing, that is putting the right people who are driving the right value in the right places so that you can allocate profits legitimately to them. Use of tax incentives, why ignore these things while they still survive? If you've got a pioneer business in Singapore, obviously you should be looking at ways of maximizing the profits that get allocated to the business. And then finally, tax system arbitrages, hybrids, that is things like instruments that are treated as debt in one location, but maybe treated as equity in the other. So you get a one-sided tax benefit, which is tax deductions on the debt side, but no pickup on the equity side, because returns from equity don't get taxed. Basically, this is everything that we're focusing on in BEPS. However, what they can't do is take away these strategies if they are undertaken for bona fide commercial reasons, i.e. there is a good commercial reason for why you would want to do these things. And one of the difficulties OECD has with BEPS is that if you do stick your people physically in a particular location, it becomes difficult for them to say, no, do that, because you simply can. It's commercial. So this is what we look at when we're putting a structure together. We look at the investment life cycle. And really, there's three phases that you need to pay attention to, and how much attention you pay to each one may be determined by the type of investment that you are actually making. The three periods, the three phases: acquisition, holding period, and acquisition issues. Obviously, you've got things like stamp duties, which typically get charged on the purchaser, capital duties if you're issuing shares in certain countries. And then the question of asset versus share deal, because that can make a big difference to your acquisition cost profile. And we'll come to that in a second. And then the question of, well, if we acquire our investment way, does that prejudice the tax efficiency of the exit? Are we prepared to take an additional cost up front to get the structure in the way we want it, because we know we're going to make loads of money at the end when we get out of it, and would rather pay a bit now than save money later on? So those sorts of issues come into it. I'm not going to go through, in the interest of time, the asset versus share deal in any detail, because this is something that we can come back to in a later thing when we look at maybe M&A type issues down at the nitty-gritty level. But there are obviously pros and cons to doing asset deals. The most commercial one is, when you buy shares, you inherit all the skeletons in the cupboard. When you buy assets, you just have to kick them to make sure they're really there. But there are tax features in there. Probably the most first line: what is good for the goose isn't necessarily good for the gander, which means that as seller, what's good for me doesn't necessarily mean, as purchaser, what is good for you. And so that can lead to a degree of negotiation and argy-bargy, which I think we'll leave for a later time, because obviously, nitty-gritty M&A stuff is an art form on its own. So we'll, as I say, we'll leave the asset deal in the interest of getting through this, but I'm sure that we'll return to it. Debt pushdown was the one I mentioned earlier, and really that was aimed at trying to get debt down into your operating structure, your operating entity, so that you create tax deductible interest expense, which excuse me, is then in a country that imposes a lower rate of tax, or one that possibly doesn't, even say for Hong Kong, for example, which doesn't impose tax on foreign sourced income at all. Obviously, nowadays, you've got to think about what we call thin capitalization rules. You can't put excessive interest expenses into countries and expect to get tax deductions for the whole lot, as you used to be able to do, you know, a number of years ago when I was a boy. It was the sort of thing. Again, debt push down. I mean, this is just one way that it can be done, which is that you set up a new co in the country, and instead of buying shares of the target, you buy its business. The borrowings from the parent company give rise to interest, which is deductible against the income from the business that you've just bought. So a fairly similar, I suppose, straightforward concept, but there are bits around it. And in different countries, you've got as to how you can push debt down to the acquisition level, to the target level. And then there's the holding period. Well, two things to say about the holding period. Obviously, if you are receiving returns as you go from your investment, then you will want to make sure that things like dividends, interest, royalties, management fees are brought back with the least tax drag, so that you've got your permissible transfer pricing sorted out and you're maximizing your profits in the lower tax jurisdictions. Now, I say that advisedly in the context of it being permissible, legitimate and proper. If it is, then there's little that can be done about it. However, there will be certain investments that people make, private equity, for example, venture capital, where they're not really worried about stuff because the businesses they're buying, et cetera, they're in a growth phase, and the aim is simply to build them up, sell them off, essentially, and that's when the capital gain piece comes to the fore, which we'll look at in a second. Efficient repatriation drivers center around things that we've slightly discussed, which is that dividends coming up are generally non-deductible and so therefore very stodgy as a repatriation, so often subject to withholding tax. So your effective repatriation rate on a dividend isn't just the corporate tax rate in the local jurisdiction, it's also the withholding tax rate on the dividend that you pay out of those after-tax profits. Interest is probably the most flexible one because it's a question of lending rather than funding with equity, and that can give you quite scope. Royalties obviously depends on the property that you're allowing your investments to use. And again, service fees, you know, are you actually providing any services? And the questions around that will be largely transfer pricing at the end of the day. Is what you are charging at arm's length and reasonable? And the other thing to note in there is that you can't cherry pick, so that if you've decided that you do have intellectual property and someone's using it, you are providing management services, you can't say, well, we'll charge these guys, but we won't charge those guys. One thing that tax authorities look for is consistency in these things, not only in their application year on year, but their application year after year as well. So you haven't got a free rein. This slide here just effectively shows you the benefits of pulling tax deductible interest out because you financed with debt rather than equity in a situation where you've got the other country has a tax rate of 30% and a dividend withholding tax rate. You can see that by pulling a reasonable amount of interest out, you can reduce that effective repatriated tax rate from 37 down to 30. And of course, that is different for every country. You need to do the maths on that. And then finally, on exit, what are the objectives? Well, obviously, you don't want to pay tax on exit if you can help it. And so what are the things that might hit you? Stamp duties. Well, yes, they can hit you, but usually, traditionally, stamp duties affect the purchaser. But it does, if it does, it may mean that you have to drop your price because it's no longer acceptable once you stick the stamp duty cost on top of it. Taxes on capital gains, as I mentioned earlier, some countries will tax non-residents when they are selling shares in companies in their country. Some tax treaties give relief for that, some treaties don't. Yeah. And so a bit of a whistle-stop tour, but a little diagram to see if you can explain what this typical structure is about and what you might be looking at for each level and what the risks are. This is something that I can maybe set this for you for homework, because obviously we don't have the luxury of strolling through it in great detail, but what we've got here, and this is a typical structure for real estate funds and other funds, possibly even private equity, where you've got the asset buried down in another location at the bottom of a pile. Why would you possibly need all of this stuff on top of it? Why don't we just have the local investment vehicle, et cetera, et cetera? Well, I suppose the reason is working from the bottom up. If you sell the asset from the investment vehicle, you're almost certainly going to be paying local tax, and of course that may be expensive. Added to which, if you've paid the local tax, there may be withholding tax on dividends, et cetera, so that makes it an expensive option. Even if you need to do that, you would want to have a SPV1 in a treaty country which reduced the withholding tax on extracting those profits, but in its own right didn't impose any significant additional corporate taxes, and then, lo and behold, didn't impose withholding taxes on onward distributions of those profits. Now, if SPV2 is in a tax haven, by definition, it doesn't have any tax treaties, and the only way you can get no withholding tax is if SPV1 territory doesn't impose withholding tax on those distributions in the first place. And once you got it into SPV2 in the tax haven, off you go into the countryside, the fund's usually in the Cayman Islands. But so that may be why you're wanting a structure like that if you're selling at the bottom and distributing upwards. But you may be able to exit at another way. You can sell the local investment vehicle, but if that's got real estate in it, you're unlikely to be treaty protected. And so you get no further down the track. If you then sell SPV1, well, that may be good, because you say, well, I'm not selling the local entity, I'm selling a company in another country, therefore I don't have any local capital gains costs. Problem with that is that many countries now are simply ignoring SPV1 and arguing that the sale of SPV1 is an indirect transfer of the local investment vehicle, and therefore they're trying to tax it, essentially. So they're just sweeping SPV1 away. That's going to be a risk at every level. Even if you sell SPV2, they're going to say, well, this is an indirect transfer. And of course, above that, you've got no treaties to protect you. In the absence of those things, if we were selling SPV1, then the issue there is whether it imposes any capital gains tax on disposals, or secondly, whether it is subject to stamp duty or other transfer taxes. That may not affect you as vendor, but it may again put the price up for your purchaser. So if you sell SPV2, you save everyone the tax, the trouble, etc., etc. So that is a real whistle-stop tour of the I suppose the building blocks of international tax structuring and sort of how we get where we are. So I'm aware that we're low on time, and this slide doesn't actually help because for some reason I've done it bit by bit, but we'll try and run through it. But this, oops, sorry. This slide basically tells you the picture that everything is getting more complicated around tax planning. In the good old days, you could say rather naively that it was relatively straightforward. You reached for your tax treaty manual, you read down the list, you say, well, if we stick Labuan on top of Korea, then dividends don't have withholding tax, and then we flash it over here and do that. Well, the world has changed now, and there's been a very large tendency to conflate tax evasion with tax avoidance. So those two things that seem to be separate on the diagram there actually are converging quite dramatically. And so some of the things where you thought there might not have been penalties, et cetera, or jail sentences, you could end up being wrong. So that's the one thing that is changing out there. The other thing is it's all about information. Look at all the initiatives that there are lying around for passing information to people. You know, multilateral conventions to implement tax treaty related measures, exchange of information upon request, automatic exchange of information between tax authorities, common reporting standards, intergovernmental agreements, FATCA, et cetera, and tax treaties, which I suppose started it all off with their exchange of information articles, have, as I mentioned at the beginning, been significantly augmented by all this other stuff that is going on all around you. So what you can't do nowadays is assume that because you're telling one tax jurisdiction one story, that story isn't going to get back to the other one. Some people spend a lot of time trying to analyze these things and find ways around the reporting requirements. To be honest, it's easier just to accept that everyone's got all the information. So, you know, be very, very careful if you are contemplating any transactions which rely or used to rely on not telling everyone the full story, because it is not increasingly, well, should never have been done anyway, but it's increasingly a silly way forward. And it's also about substance, and this is the commercial aspects of why you've put these boxes above somewhere else. Why do I have Labuan sitting above Korea? Well, if Labuan is just simply an empty box, then that will be ignored completely from now on. You have to have people there. You have to have commercial substance around the reasons for having that entity in there in the first place. And you also have to be the beneficial owner of the income, which means you can't just be a conduit to flash the income through. There has to be someone in there that can stop the income, take a look at it, and decide what they want to do with it without having to pass it on immediately. So those are two big areas now which you simply cannot ignore. And the manifestation of this you may see in the context of Singapore, trying to get a certificate of residence now for a holding company that is more than 50% owned by non-residents is like finding hen's teeth. That is all built around having to have a commercial reason for Singapore and having some substantial arguments around why you need that Singapore entity. And as I've said, the final one, taxation of indirect transfers, notwithstanding the fact you haven't sold a company in a particular country, but you've sold higher up the ownership chain, these can all be swept aside and deemed to be transfers of the underlying shares. Here's some of the countries that have done it, that have been moving in that direction. So we're surrounded, basically, here in Singapore. And here's how cooperative Singapore has been. I'm not going to take you through this, but yes, largely compliant in force. Yeah, they are well on their way to signing up to everything that is going. So on that note, slightly late, but I will take any questions now if I'm able to turn on my video and look at the questions. Right.
So David, you'll see the Q&A button at the bottom. There have been 3 questions
Yes, I've got
submitted.
the Q&A. Am I on the screen? So we have one here, not vast numbers of questions. How do you feel that the new tax rules regarding substance in certain tax havens would affect tax structuring? And do you think these rules could benefit Singapore? Maybe working it backwards, I think, you know, the reputation of the treaty, these tax haven countries are already helping Singapore, because Singapore isn't, I suppose, mired in the history and now the common thoughts around, you know, just automatically being dodgy and avoiding tax, or being a mechanism for avoiding tax. Oh, somebody's requested remote control of my screen.
Me, David. Just someone's asked if we can flash the last slide again.
Oh, hang on. So do I say yes? Do you want it back?
Yeah, I'll do that, and then you can carry on answering the Q&A.
That might not be that easy, because all right, okay. So sorry, the question was about the Cayman Islands, the traditional tax havens. Yes, I think they've been hoisted by their own petard in terms of the reputation that they've created for themselves. I suspect that some of the changes they've implemented have been more lip service than substance, and the Cayman Islands is still blacklisted because they've been dragging their heels a bit. So yeah, I would imagine that that it still advantage Singapore as far as that is concerned. Singapore is very concerned about substance, economic viability of the businesses that they allow to come in, and certainly businesses they give tax-free rides to. So I think we're still there. Chris has asked, would SPV1 have a risk of being treated as treaty shopping? And I presume that's reference to the diagram. And yes, the answer is of course yes. That SPV1, which sat up above the local holding company, the local operating company, would have to show, in order nowadays to get tax benefits, to get those reduced withholding tax rates, would have to show that it has some substance and some reason for being constituted and resident in that location. So very much. So, you know, at every level you go up that chain, there are certainly questions to ask, and there are certainly problems to be solved. Is the Vienna Convention of the Law of Treaties relevant or useful in tax treaty interpretation? Well, I suppose yes and no. I mean, this goes back to, I suppose, two aspects of it. One, the treaty itself should stand on its own, and you should interpret, you know, backwards, up through the chain that I set out. treaty should be interpreted in according to the spirit of the treaty, i.e. does the answer that we come to give you a fair result, which you would have expected a treaty whose stated aim is the avoidance of double taxation. Are you getting a fair result out of that? If you're not, then you might be interpreting the treaty in the wrong way. But any external references that can be had that help you in that interpretation, as long as they don't contradict the underlying principle of the treaty, can be useful. But it's not anything that I can say that we reach for on a regular basis. I think you're talking very, very, very fine points of interpretation and law if you get that far down the track. And we have another one. Yeah, no, I've had as a BVI and Cayman lawyer, a slightly unfair picture being painted of offshore centres. Yeah, well, apologies for that. I'm obviously trying to promote Singapore, which are hard to continue to be compliant with all international standards, which is, as you'll be aware, are a moving feast at the moment. Yeah, no, I absolutely agree with that, and I apologise if I was probably being a bit harsh on where the BVI and Cayman are, but I won't deny that the picture is changing, and obviously these jurisdictions have a lot of work to do, to keep it going. And the comment about things being a moving feast, absolutely. I mean, the diagram I showed you with all the information exchange protocols, etc., is only scratching the surface when you've got all the BEPS initiatives that go in and around that, when you've got the Pillar 1 and Pillar 2 rearing their very ugly heads. And this conflation, as I said, of tax evasion and tax avoidance, there is a lot going on. And as you say, Michael, a complete moving feast with a lot of work to do. I could say it's a good time to be a tax consultant because there is a lot of stuff to navigate through. And I think that is possibly the end of... Oh, there we go. Has someone taken control of my screen?
I think you have it back now.
I have it back. Right, sorry. So where are we now in the proceedings?
I think we're ready to close off now, David.
Yes, because I was indicating that those were the last questions that I had. So unless maybe anyone's got any other questions.
There's been one question that's come in that says, what are the benefits of having a hybrid entity in Singapore?
What are the benefits of having a hybrid entity in Singapore? It depends what that means. I would have to get more information on that. I mean, there are hybrid structures. I'm just trying to think what you would term a hybrid entity. No, perhaps if the person asking the question could just elaborate a bit on what they specifically had in mind. As I mentioned, hybrid instruments are certainly being attacked, and those are the ones that give you unequal tax results, usually to the benefit of the taxpayer.
They said, David, opaque entity with a US LLC.
Okay, so a US LLC. Sorry, I didn't get I couldn't see the full follow on there?
So it says, what are the benefits of having a hybrid entity in Singapore, opaque entity with a US LLC? We can always follow up with the person who's asked the question separately.
Yeah, I think I should, because obviously, you know, the United States has got a couple of things. So I suspect what they were maybe getting at was the US LLC can either be a tax transparent entity, or you can convert it into a tax opaque entity, which means it effectively becomes like any other company. The other way round, US investors can do what's known as checking the box of a Singapore company, which effectively turns the Singapore company, although in corporate form, into a tax transparent entity, but only for US tax purposes, not for Singapore tax purposes. So as far as Singapore is concerned, it's not a hybrid. As far as the US is concerned, then it may be, it may do certain things, but talking about US tax is a bit off my patch for this morning, I think. But happy to follow up with whoever asked the question.
Yep, I think we're ready to close off there then, David.
Okay. Well, thank you very much, everyone. I know it was a lot to pack in to one thing, but I hope it's given you the wherewithal to understand better some of our subsequent topics, which will be coming up. So watch this space where we'll be building upon some of these blocks and taking them forward, particularly in the area of transfer pricing, which, as I mentioned, something that we didn't really cover in any depth today. But to everyone, enjoy the rest of your day. Go out this evening, have a nice meal, and let's get back to normal. So thank you.